Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Last week saw the Russia-Ukraine standoff escalating into an outright conflict. Our hearts go out to all those directly or indirectly impacted through this situation. Financial market participants distantly located from the epicenter of this conflict were impacted too, as breaking headlines induced volatility into financial markets across the globe. While we make no predictions about how the Russia-Ukraine situation would evolve further, on this week's podcast we try to share our thoughts on what we think will be the market implications of these recent developments over the short, medium and long term. Let's dive into this week's content. A sharp escalation in the Russia-Ukraine standoff quickly spiraled into what is arguably the biggest military conflict in Europe since the Second World War and caught many investors, including us, by surprise. What was initially seen as a peacekeeping mission by the Russian troops in Ukraine quickly turned into a full-scale invasion, and this resulted in a range of punitive sanctions on Russia by the West. Financial markets were hit by volatility as they tried digesting the barrage of headlines. While we bear in mind that the situation continues to evolve, in this podcast we try to assess the implication of this development based on the information we had at the time of recording. We try assessing the impact on three different time horizons: short term, medium term, and long term. In the short term, while it is difficult to time the turn in the market sentiment, as the geopolitical tensions abate, financial markets could see a tactical bounce over the next weeks to months. As such, most geopolitical risk-off events of the past provided a good buying opportunity, with most risk assets recording a robust performance over the subsequent 12 months. Of course, this time around, there are additional drivers, including the concerns about a tighter monetary policy, that put any durable bounce into question. Yet, looking at the recent market performances and putting them against the historical templates of escalating geopolitical tensions, one should expect a move higher in equities led by cyclical segments including emerging markets and Eurozone equities by geography, and information technology, consumer discretionary, industrials and materials by sectors. Rise of geopolitical risks in commodity exporting countries has always embedded a premium into the prices, which remained high even during the normalization phase. Oil, industrial metals and food commodities have been in focus over the recent weeks. Here we think oil prices have already embedded a significant risk premium and could be vulnerable to any increase in supplies by the OPEC members or the return of the US shale production. Equally, should additional sanctions target Russian energy exports, oil prices could rise sharply too. Food prices could remain elevated through the spring months of the northern hemisphere on unfavorable weather and potential disruptions to supplies from Russia and Ukraine. FX trends showed a mixed picture in the past episodes of the rising geopolitical tensions, but given the current situation, it may not be unreasonable to expect the euro to recover against the US dollar in the very near term. Now, expanding the horizon and thinking about the medium term, which we consider is the next 12 to 18 months, the recent rise of geopolitical risk could have a range of implications. In our view, the fundamental impact of any sharp rise in commodity prices due to disruptions and the implications of sanctions are likely to be felt on this time frame. Here, as we know, Russia and Ukraine are both major commodity producers. Russia produces about 10% of the world's oil, and Russia and Ukraine together account for 1/3 of the world's wheat and 1/5 of the world's corn production. Russia produces about 40% of the world's palladium and about 6% of the world's aluminum. Any interruption to energy exports from Russia could also have secondary impact on production of goods in the importing countries. Also, these disruptions could have more acute impact on some regions compared to the others. Here, Europe stands out being more vulnerable thanks to its geographical proximity to Russia and Ukraine, strong trade and financial linkages, and higher dependence on Russian energy. Sanctions on Russia by the West continue to be tightening even at the time of recording this podcast. Sanctions imposed by European Union, the UK and US so far were aimed at Russia's oligarchs as well as banks, high-tech companies and aircraft manufacturers. At the time of recording, Financial Times reported that Western leaders are considering sanctions on Russia's central bank and to cut some lenders from the SWIFT global payment system. Whilst it is true that some of these sanctions could impact the growth of the developed market economies, most acute impact could be felt in Russia. Developed world central banks, which were about to embark on a policy normalization path, could face the conundrum of further rise in prices of energy and other commodities, but also prospects of weaker growth in their domestic economies. Switching gears and thinking about the long term, that is over the next couple of years and beyond, there could be wide-ranging implications difficult to quantify at this stage. Risk premia could rise for European markets due to their geographical proximity. Also, markets could extrapolate the events in Russia and Ukraine to other regions, for example Asia, and that could increase the risk premia there too. This reinforces our thesis of lower long-term returns for financial assets broadly. A multipolar world with the rise of the East was already underway even before this event, which was already challenging the hegemonic stability of the world. Deglobalization, slow lane globalization, hyperglobalization, whatever one might want to call it, could pick up pace and in turn reshape trade and financial relations across the globe. Spends on defense goods, cybersecurity, energy security, and food security should rise sharply across major economies. In summary, in the near to medium term, a tactical bounce in risk assets is possible as geopolitical risks fade into the background. However, that should shift the focus back to renewed dilemma of central banks and feed into uncertainty for financial markets. This means headline volatility will remain high over the next couple of months, possibly paving a way for better second half of the year. But in absence of concrete evidence of a recession, we think it is prudent to stay invested with a diversified and disciplined approach. We reiterate our asset allocation strategy of staying overweight cash, underweight bonds, and neutral on both equities and alternatives. Thanks for listening. In case you found this podcast useful, please do share it with a friend or a colleague. Also, if you'd like to get more information on what was discussed on this podcast and to understand the impact of geopolitical risks on your portfolios, please reach out to your contact at ADCB. You can also log on to our website www.adcbam.com for more information. This is Kishore Muktinutalapati signing off.